The first idea is that yield is not return. Dividend yield usually compares annual distributions with current price or net asset value. It says something about the cash paid relative to the price. It does not say that the investor earned that same percentage. If the price falls, the distribution may only offset part of the loss. If the price rises, the total return may be higher than the distribution. The more complete measure is cash received plus price change minus fees and taxes and adjusted for the investor's actual use of the cash. The second idea is to separate the source of the distribution. A company dividend may depend on earnings, free cash flow, debt, capital spending, and board policy. A fund distribution may come from dividends, interest, realized gains, income equalization, option premiums, or other rules. A cash payment that looks stable for a few periods may not be permanent. If the source is not clear, the household should not treat the payment as guaranteed income. The third idea is that cash distributions and asset value move together. When an asset pays cash out, the value of the asset is also affected. Market prices may also move because of rates, recession risk, sector pressure, or company fundamentals. A household can receive cash while the balance sheet becomes weaker. This is why the cash flow line and the market value line must be shown on the same page. The fourth idea is that distribution policy can change. Profits can fall, interest rates can change, capital expenditure can rise, fund rules can be revised, and regulation can alter the economics of a strategy. Treating 1 year's yield as a permanent salary is fragile. A better habit is to ask what happens if the distribution falls by 30%, by half, or is skipped for a period. If the household plan breaks immediately, the income assumption is too aggressive. The fifth idea is that high yield is not the same as low risk. Some high yields are supported by mature and durable cash flow. Others appear high because the price has fallen and the market is demanding compensation for risk. A yield that rises because prices dropped may be a warning, not a bargain. Ask why the price is low, whether the payout is supported by cash flow, and whether the asset is concentrated in a fragile sector. The sixth idea is to include taxes and costs. A distribution may be taxable. A fund may have management fees, trading costs, currency costs, or withholding taxes. Pre-tax income is not the same as spendable income. For an investor building wealth, tax and cost drag reduce compounding. For a retiree using cash flow, after-tax cash is the number that matters. The seventh idea is that receiving dividends and selling a small part of the portfolio are both ways of turning assets into cash. Many people feel that spending dividends is safer than selling shares. The psychology is different, and taxes or transaction rules can be different, but both choices affect the economic value of the portfolio. The key question is not whether the cash feels natural. The key question is whether the withdrawal method fits total return and risk. The eighth idea is reinvestment. During the accumulation stage, spending every distribution may slow portfolio growth. Reinvesting distributions may be closer to the long-term compounding path. During retirement, the distribution may genuinely support spending. The right answer depends on life stage. Accumulation, transition, and withdrawal stages need different cash flow rules. The ninth idea is household timing. A household may need monthly spending, while distributions may be quarterly, semi-annual, annual, or irregular. If the spending need is steady but the distribution is uneven, the family still needs a cash bucket. Dividends can contribute to spending, but they should not be the only timing mechanism. Necessary expenses, flexible expenses, and long-term investment capital should be separated. The 10th idea is that dividends do not replace emergency reserves. In a market stress, distributions, prices, and liquidity can all become less reliable. Emergency reserves need stability and immediate access. High-yield assets may produce income, but a family should not remove its safety cushion simply because it owns income-producing investments. The 11th idea is concentration risk. Some dividend strategies lean toward financials, energy, utilities, telecommunications, real estate investment trusts, or a narrow set of high payout companies. Concentration is not automatically wrong, but it must be visible. The investor should know whether the portfolio is sensitive to rates, regulation, commodity cycles, one country, one currency, or one sector. If the household's job income is also tied to that sector, the combined risk is higher. The 12th idea is a three-layer dividend checklist. Layer 1 asks where the distribution comes from. Layer 2 asks what happens to total return, price volatility, concentration, rates, currency, fees, and taxes. Layer 3 asks what the household will do with the cash, reinvest, fund living expenses, support retirement withdrawals, build a cash bucket, or pay a specific planned expense. A distribution is useful only when all three layers are understood. The 13th idea is not to use yield as the only screen. Sorting assets from highest yield to lowest can pull the riskiest names to the top. A more useful screen asks whether the payout is supported, whether purchasing power can be maintained, whether holdings are diversified, whether fees are reasonable, and what happens if the payout is cut. A high number without context is not a plan. The 14th idea is inflation. A cash payment today may buy less in the future. Medical expenses, care costs, rent, and daily living costs can rise. If distributions do not keep up with inflation, the household may feel income rich, but purchasing power poor. Total return should be read in real terms, not only in nominal cash. The 15th idea is that stable distributions do not guarantee stable prices. A fund or a company may keep payments steady for a while the market value falls. If the investor watches only the cash deposit, risk recognition is delayed. Each income review should include the total market value, drawdown, fees, taxes, and the date when the household expects to use the money. The 16th idea is retirement withdrawal design. Retirement income can come from a cash bucket, bond interest, dividends, partial sales, pensions, annuities, or other sources. Relying only on high dividend yield may create concentration and payout risk. Ignoring dividends entirely may increase selling pressure. The better approach starts with spending needs and then assigns different assets to different spending horizons. The 17th idea is rebalancing. If an income asset grows until it dominates the portfolio, the household may be taking more risk than intended, even if the income feels good. If an asset falls and yield rises, that is not automatically a reason to buy more. The portfolio needs a role definition, a maximum weight, and a rule for reviewing the position when assumptions change. The 18th idea is the mental accounting trap. People often treat dividends as money they can spend and price declines as something they can ignore. That can be helpful if it prevents panic selling, but it can be harmful if it hides permanent impairment or excessive concentration. Psychology is real, but it should not replace total return accounting. The 19th idea is to write disproof conditions. Before relying on a high-yield asset, write down what would prove the original thesis wrong, repeated distribution cuts, cash flow coverage problems, rising debt, higher fees, sector risk, a drawdown beyond the household's tolerance, or an earlier than planned cash need. Disproof rules are not for constant trading. They prevent the investor from using distributions as emotional comfort while the real case deteriorates. A label that says dividend, income, monthly pay, or cash flow does not prove that the underlying assets are appropriate. Look at top holdings, sector weights, credit quality for bonds, duration, geography, currency, expense ratio, and distribution policy. The name is packaging. The holdings and rules are the asset. The 21st idea is currency. If the asset pays in a foreign currency and the household spends in another currency, the local value of the distribution can move. Foreign currency income can diversify sources, but it also adds uncertainty. Currency should be part of the stress test when the spending need is in the household's home currency. The 22nd idea is to place dividends inside the annual household budget. List necessary living costs, insurance, mortgage or rent, education, care obligations, tax bills, and flexible goals. Then assign dividend cash to a roll. It may replenish a retirement cash bucket, fund plan spending, or be reinvested. If the money simply arrives and disappears, it may not improve financial security. The 23rd idea is stress testing. Ask what happens if the distribution falls by 30%, the market value falls by 20%, taxes are higher than expected, or the household needs cash earlier than planned. If the plan fails under one ordinary shock, the yield is only surface comfort. A stress test tells the family when to reduce risk, add cash, or change the withdrawal method. The 24th idea is expectation setting. Family members may hear dividend and imagine a fixed salary. It is better to define the distribution as one source of investment cash flow, not a promise. The principal can move, the payout can change, and total return is the long-term measure. This conversation prevents disappointment when the first difficult market arrives. Add an evidence ladder before relying on the distribution. At the top are repeatable cash sources, operating cash flow, free cash flow, interest income, rent, or other durable earnings. In the middle are realized gains, accounting smoothing, or cyclical income. At the bottom are debt, new share issuance, asset sales, or return of capital. The closer the payment is to the bottom, the less it should be treated as stable household income. Build a 3-scenario table. In the optimistic case, earnings support the payout, and price follows fundamentals. In the base case, distributions fluctuate and price moves with the market cycle. In the stress case, the payout is cut, price falls, and after-tax cash is lower than expected. For each case, write the household action, reinvest, hold cash, reduce spending, rebalance, or pause withdrawals. Put distributions and market value in the same annual statement. One column shows cash received. Another column shows the gain or loss in market value. A middle line subtracts fees, taxes, and currency effects. If the cash column looks good, but the market value column keeps deteriorating, the household may be spending the asset base. If the cash column is modest, but total value grows, the total return result may still be healthier. Give the cash a spending order. First come necessary expenses or a retirement cash bucket. Second comes reinvestment to protect future purchasing power. Third come flexible expenses such as travel or lifestyle upgrades. If distributions disappoint, only the highest priority use should remain. If distributions are unusually high, the family should not automatically convert a temporary payment into permanent spending. Set an allocation cap. A dividend strategy that grows from a small sleeve into a dominant position can quietly reshape the whole portfolio. The investor may feel income rich while taking concentrated sector, rate, currency, or product risk. Define the role of the income sleeve, its maximum weight, and the rebalancing trigger before the yield becomes emotionally hard to reduce. Check recovery capacity after a payout cut. The important question is not whether distributions can ever fall. They can. The question is whether the household can recover when they do. If income drops by 30%, can the cash bucket cover a year of needs? If price also falls, can the family avoid selling at the worst moment? Recovery time is a better safety measure than a single annualized yield.